Welcome back. This morning, the Empire State Manufacturing was reported. Last month, the number was really bad. This shows an improvement, but nothing really to celebrate. What this does is it rates the relative level of general business conditions in New York State, specifically reflecting the manufacturing industry. Levels above zero indicate improving conditions, below zero indicates worsening conditions. This month, the index rose 21 points, but that led us off only to 1.9. We can see last month, the yellow histogram bars show us the manufacturing index registering levels of negative, around negative 20 almost. This month, again, 1.9, but it shows us we're just barely above the positive level. The red line is the S&P 500. And we can see over time, going back to the beginning of 2022, this has spent most of the time in negative territory, really only registering highs, significant highs above 20, going back to April of last year. Interesting enough, this indicator really started to mark some negative reports around mid last year, which was the beginning of the inverted bond curve. And again, here's a different look of exactly that. The inverted bond curve occurred when the 1 year Treasury note, that's the blue line, crossed above the red line, the 10 year Treasury. Normally, we expect to see longer term maturities offering higher yields, but when we have economic strife, the opposite happens. Notice the manufacturing index was hitting levels of 30, 40 in 2020, 2021. And then when we saw the inversion take place, that's when we saw very shortly after that a negative 30. Negative 30 is a pretty bad number as far as this index is concerned. We saw that number of times. Last month, we registered a negative 20 in that area. Again, we're at 1.9 to the positive side, but if we expect to see negative, another negative report, it would be very interesting to see how negative that is. Now, taking a step back, we've seen CPI that today, or this week, I should say, PPI, the inflationary numbers. The Federal Reserve is going to meet next week. We just had rather soft employment numbers recently. How does this affect the stock market? Well, when we talk about the stock market, there's four major indices in the US: Dow Jones Industrial Average, S&P 500, NASDAQ, and Russell 2000. They're made up of different stocks. Now, generally speaking, we talk about stocks as one index or one market, but there really are differences within the stock market, and how those different companies and industries behave really do sometimes tell us something. Now, specifically, we look at the stocks in terms of their size, the size of the companies. The Dow Jones Industrial Average is comprised of 30 of the largest listed companies. These are companies we all know: American Express, Boeing, Home Depot, Coca-Cola, Walmart. That's the benchmark. S&P 500. Now, the benchmark is the benchmark, but it's also quite narrow. This covers the 30 largest companies, but certainly does not represent the overall economy oftentimes. It's just the 30 largest companies. The S&P 500 lists the 500 largest market capitalizations. This is more representative, I would say, of the overall economy. This covers a lot of different sectors, from technology to healthcare, automotive, industrial, manufacturing, housing, etc. We have the NASDAQ, which is comprised of around 2,500 stocks. That's heavily weighted towards technology and healthcare to a lesser extent. And then we have the Russell 2000, which is a small cap index. This shows us the small companies that hopefully will become one day big companies. But the small companies are much more sensitive to economic downturns. They tend to do very well during strong economies, but very poorly during weak economies. Now, in order to compare all of these on an apples to apples basis, we calculate the spread. Well, first we rank them from 0 to 100. If it has a ranking of 0, it means that that index is at its 52-week high. So take a look at the chart right here in the middle. This goes back to July of this year. We see when the stock market was hitting its 52-week high, its yearly high. The red line, the Dow Jones Industrial Average. The purple line, the S&P 500. The green line is the NASDAQ. The yellow is the Russell. All those stocks, those specific indices, were hitting 52-week highs. And that occurs as we see a zero over here when we're at the high. If we see that the market has pulled back and we're trading, let's say, on the within 10-day high, so to speak, it would register a 10. The longer we go down, or the more we go down, and we see, let's say, a 300, it means it would only be trading at the 300th best day over the past 360 days, in the calendar year. Then the black line at the bottom shows us the spread, the difference between the strongest and the weakest. And there's a couple nuances to this. When the market has picked a direction, we tend to see all stocks move in the same direction. But when all stocks are moving in the same direction, like they were in July, we should be warned because not all stocks are naturally always going to move in the same direction. And this tells us we're hitting a market extreme, either to the upside or to the downside. But it's not a natural state for all the stocks to be going up at the same time. And that when that spread gets very low on a relative basis, we expect a reversal. When that reversal comes, we usually see one index break before the others. In this case, the yellow line, the Russell 2000, seems to have broken first and went to the downside. Also, the green, the NASDAQ. So we see here the small cap stocks and the NASDAQ, the technology stocks, broke first. That red line, the Dow Jones Industrial Average, remained quite resilient right over here. This stayed near the highs. It shows us that the Russell 2000 broke before the others. Well, let's take a look to see how this behaved historically speaking. Now we go back to the year 2000. All the indices, or very close to all the indices, were trading near their highs. Take a look at July, August of 2000, the purple line, that's the S&P 500. It was at its 52-week high. The blue line, the Dow Jones Industrial Average, the red, the Russell, the white, the NASDAQ, they were all right near the highs, and the spread was very low. But take a look to see what happened. The white line broke first. That was the NASDAQ. What was the stock market crash of the year 2000? It was a technology stock crash. Other stocks also, of course, but notice how the technology stocks really went down first and went down the hardest. This shows us what led that crash. Now, fast forward to 2018. Again, Dow, S&P, Nasdaq, Russell are all right near their historic highs, 52-week highs. The spread's very low. Look what broke first, the Russell. We see a huge break in Russell, followed by the Nasdaq. Look what was very resilient, the Dow. So we take a look at our investment portfolio. Let's go back to this time. Well, if we have any investments in small cap stocks, it's probably a good idea to get out of those. Those look like they're breaking the first. If you want to, maybe move your investment capital in something that seems a little bit more of a safer vehicle, maybe the Dow Jones Industrial Average at that point looked to be more stable. Eventually, they all did go down, but that shows us really what went down first. Well, fast forward again to present day, where are we now? We see July, and we took the spread out just to give a more clean, zoomed in view of what we're looking at here. The red line, the S&P 500, the red line is the Dow, S&P is purple, NASDAQ is green, Russell's yellow. All were trading near their highs. We broke down and then we saw a reversal. We didn't come back up to our yearly highs. And if you take a look at a regular stock market chart, it probably looks in like a very similar pattern. We were at all-time highs or yearly highs in July. We had a big break in August. We came back up late August, early September. Look what has happened. Look what's really suffering. The Russell. The Russell is down at a ranking of around 130. So it's only trading probably within 60 or 70% of its 52-week range. The green line, the Nasdaq's also really getting hurt. The Dow, the S&P 500, those look more resilient. It doesn't mean those indices also can't come down, but notice what happens, especially with the Russell. And this is really a lesson, for us moving forward. Small cap stocks, small companies can be fantastic investments. And when we have a bad economy and it starts to improve, it's a good idea, at least according to this math, to get involved in small cap companies. Once upon a time, Uber, Microsoft, they were all small companies. And in the right environment, they became huge. But when we see trouble on the horizon, the small cap companies get hurt first. Remember in 2008, the small cap banks went out of business JP Morgan and Bank of America were able to weather the storm. So there is a time and a place for different types of investments. But at the moment, it looks like the Russell, the small cap stocks are really starting to, move to the downside. What does that say about the rest of the market in the weeks and months to move forward? Well, it's anybody's guess, but if history's any judge, when the Russell goes down, you know, certainly this does not bode well for some of the other companies as well, other indices, we should say. We hope this has been helpful. We look forward to seeing you back soon.